On November 8, 2016, a sudden policy shock immediately invalidated 86% of India's circulating physical currency. The overnight withdrawal of legal tender status from the 500 and 1,000 rupee notes triggered a massive logistical disruption. Normal economic functions stalled as citizens scrambled to exchange their suddenly obsolete cash. The objectives of this shock were twofold: to flush out unaccounted wealth from the informal sector and to forcefully accelerate the adoption of digital payments. On the digital front, the policy found a powerful catalyst. Transactions on the Unified Payments Interface, or UPI, surged, growing at a 49% compound annual rate by the mid-2020s. On the surface, the transition worked. The sheer velocity of digital adoption created an almost universal expectation that India's reliance on physical cash was permanently in the past. This bar chart tracks currency in circulation over the subsequent 9 years. Contrary to expectations, physical cash did not disappear. It more than doubled, rising from roughly 18 lakh crore rupees in late 2016 to over 37 lakh crore by October 2025. This physical accumulation occurred simultaneously with the digital explosion. In fiscal year 2025 alone, the system processed 185.9 billion digital UPI transactions, alongside record levels of printed paper. Yet looking closely at this final metric, the ratio of circulating currency to gross domestic product, we see a structural decline. It dropped from 12.1% prior to the shock to 11.11%. To understand why central bankers view this dual expansion as a sign of stability rather than a policy failure, we must strip away the surface-level politics and deconstruct the hidden architecture of the money supply. Physical banknotes are only a fraction of what central banks actually consider money. The Reserve Bank manages an aggregate money supply. This supply is categorized by a single metric: liquidity. It measures how instantly an asset can be converted into spendable cash to settle a transaction. This diagram illustrates liquidity categories. The dense core is M1, combining physical currency and instantly accessible checking accounts. Expanding outward, M2 incorporates slightly less accessible assets, adding post office savings deposits to the M1 base. The next layer is M3, or broad money, incorporating institutional time deposits that cannot be withdrawn instantly without penalty. M3 is the primary macroeconomic planning metric. Finally, M4 captures all remaining long-term deposits, the absolute broadest monetary measure. The physical cash citizens queued for in 2016 represents only that tiny M1 core. Most of the money supply operates invisibly as banking credit. If the broad money supply is mostly credit, how does that initial value enter the system? The foundation is high-powered money, often called reserve money. This is the absolute base layer of value, directly created and controlled by the central bank. This reserve money acts as the vital seed capital. It is injected directly into the commercial banking sector to provide baseline liquidity. Commercial banks do not simply hold these reserves in a vault. To generate yield, they are mathematically required to lend a large portion of those deposits back out to the public. The central bank issues the monetary base, but relies on commercial banks to multiply it. This equation shows the mechanical relationship between high-powered money and total multiplied deposits. The variable X is the cash reserve ratio, the percentage of deposits the central bank locks away. This reserve limits a bank's lending. The variable B is the public's cash preference, the funds individuals choose to extract from the banking system to keep in physical wallets. Whatever remains generates D, or total deposits. These issued loans eventually get deposited back into other banks, looping continuously and creating new credit with every cycle. Money supply is not dictated by a printing press. It is governed by a highly sensitive deposit multiplier, constrained entirely by central bank policy variables. The money supply is not dictated by the speed of a printing press. It is governed by this highly sensitive deposit multiplier, constrained entirely by policy variables. Central banks actively modulate this engine to steer the economy through periods of boom or recession. The primary lever is the repo rate, the foundational interest rate the central bank charges commercial banks for short-term funds. This maps the monetary transmission mechanism. During a tightening policy, the central bank turns the valve, raising the repo and cash reserve rates, immediately draining liquidity from the banking sector. The volume of loanable funds shrinks, and the cost of borrowing spikes upward. This expensive borrowing suppresses private investment, mechanically contracting aggregate demand and cooling off inflation. The reverse is also true. Lowering rates opens the valve, flooding the system with liquidity to stimulate borrowing during a recession. Modern central banks manage macroeconomic stability by steering this specific transmission mechanism to influence the flow of liquidity. This brings us back to the 2025 data anomaly. If the multiplier is highly efficient and digital platforms handle billions of transactions, why did the volume of physical 500 rupee notes double? The answer lies in the denominator of the economic equation, the gross domestic product. Over the decade following the policy shock, India's absolute economic output expanded at more than 6% annually. The size of the entire economic pie was growing rapidly. Supercharged by digital networks, the velocity of broad money grew significantly faster than the central bank's physical printing of narrow money. This graphic demonstrates the result. Because the massive GDP denominator expands faster than the growing currency in circulation numerator, the overall ratio is forced downward to 11.11%. The absolute volume of cash had to increase simply to service a much larger economy, but proportionally, the system had grown less reliant on physical paper. This comparative bar chart tracks India's 11.11% ratio against global baselines. It remains noticeably higher than China at 9.5% and the Eurozone at roughly 8 to 10%. By comparison, the United States Federal Reserve operates within a highly formalized, deeply digitized economy, maintaining a ratio of just under 8%. India's ratio remains elevated due to two specific factors: the enduring presence of a massive informal sector and a deep cultural preference for the immediate liquidity of cash. Digital infrastructure like UPI did not eliminate paper notes, but it absorbed the immense transactional friction of rapid economic growth. Without it, the cash-to-GDP ratio would have escalated out of control. True monetary stability is not measured by the absolute number of printed notes. It is found when the deposit multiplier balances the aggregate money supply against the real growing output of the economy.